What's the worst thing that can happen to an investor? That your portfolio drops below a value that you originally started with, right? Well, guess what? We're entering possibly the most uncertain period for the stock market ever. Between the 23rd of March and mid-June, we experienced the most incredible rally in the stock market that you can ever imagine. Now, in that time, the S&P rose a record 39.6%, which is just insane, and almost as much as my hair has grown during coronavirus as well. But nah, I'm trying to keep it under control. And not only did that rally erase most of this year's COVID-19 related losses, it's also the best 50-day rally that we've ever had in the stock market. Ever. Now that's pretty insane considering that we're seeing a worldwide meltdown due to the pandemic that is COVID-19. And we've seen many countries impose lockdowns. We've seen almost 10 million cases of this virus worldwide, and many countries are imposing border restrictions as well. And whilst most forecasts are for a second spike in cases and further economic turmoil, others are more optimistic. So in this video, I'm going to share with you whether now is the time to buy, sell, or hold. And by the end of this video, I hope that you'll have a much better idea what's the right thing to do for you. But remember that there's no single answer that fits everyone. This is a case-by-case basis, and it's going to be determined based on your circumstances. Just like anything in investing, there are so many variables, and the answer is going to be different for everyone. Before we start now, guys, if you're enjoying this video so far, please give it a thumbs up and subscribe to the channel, and let's get into it. Hi guys, I'm Brett Clay and I'm making this video from a hotel room here in Singapore where I'm serving 14 days isolation notice for entering the country during the coronavirus lockdown. Now we're going to dive in and have a look at what's currently happening in the market. Keeping up with current news and figuring out what's happening in the market and what you think is going to happen in the market in the next couple of weeks and months is super important because it helps you come to terms with what might happen to your portfolio and gives you time to think ahead and decide whether you want to buy, sell, or hold your stocks. That said, emotions are a serious driver in the stock market. And to understand fully the emotion cycle of the stock market, let's have a look at this graph. Alright, so this graph is from Forbes and it shows the whole cycle of market emotions. When the market is on the rise, you're optimistic, you're feeling excited and thrilled, and then when it reaches a peak, you're feeling euphoria, you're feeling so good and on top of the world. But then when the value of stocks start to go down, like we saw at the end of last week, you start to feel anxious, you come into a period of denial where you believe that it's not going to last and your stocks are going to rise again soon. Then, as they continue to fall, you get fearful, you get depressed, and you start to panic. Then, when you're at the bottom of this graph, this is the best time to buy. This is where you've got the most opportunity to buy low, to buy cheap stocks and make a good return. Most people sell rather than buy here, and that's the difference between someone who is calm and patient and makes a lot of money in the stock market versus someone who acts with their emotions. However, if you can battle through those emotions and keep them at bay and continue to hold your stocks and buy more at this point, you're going to start to feel hope, relief, optimistic, and then again the cycle is going to continue. You're going to feel excited, thrilled, and euphoria. So guys, what does this mean? This just shows you the cycle of emotion, and emotion is so important in stocks. It's something you need to consider when you buy stocks, and you're going to feel all of these emotions all the time. So you just need to remember that emotions don't drive the stock market, although sometimes if too many people have emotions and they act on those emotions, it might. But you need to be calm, you need to be patient, and in times like this that we're seeing now, especially, don't let your emotions drive your decisions in the stock market. So let's check out the current market conditions. What's happening in the stock market right now? Well, the back end of last week saw Facebook drop 7%. It saw Goldman Sachs drop 8%, and 7% was wiped off Nike as well. Now, there are a number of reasons that these stocks have all seen recent sell-offs. For example, Facebook is seeing a massive advertising boycott by the likes of Coca-Cola and Unilever, who are some of their biggest ad spenders. So for reasons like this, we can't take an individual stock like Facebook as an overall indicator of what's happening in the market right now. To do this, we need to take a look at the indexes. The indexes track the overall performance of the stock market. Now, I'm going to be looking at the three main US indexes here because I'm investing and I'm talking about my investment in the US stock market. Even though I'm investing from the UK, or I'm currently in Singapore, but I live in the UK, we're going to be looking at the US indexes because that's the market that I'm most heavily involved in at the moment. So, my favorite of these three main indexes is the S&P 500. The S&P 500 tracks the 500 largest publicly traded companies in the US. The second is the Dow Jones, and the Dow Jones tracks 30 well-established stocks selected because they're relatively stable leaders in their respective industries. The Nasdaq is the third one that we're going to look at here, and the Nasdaq heavily tracks technology companies like Google and Facebook and Microsoft, but it doesn't only track technology companies, so bear that in mind. Now, if we take a look at these indexes' performance in the last couple of days, from the 23rd to the 26th of June, you'll see that the S&P 500 is down 4.5%, the Dow Jones is down 4.8%, and the Nasdaq is down 4.6% as well. And guys, I'd love to hear what you think about this and what you think the stock market's going to do in the next week or the next couple of weeks. If you think it's going to drop a comment saying drop. And if you think the stock market might bounce back, drop a comment saying bounce. I'm now going to cover a section in this video describing what I think this means and what I think this means going forwards as well. So prior to June, these indexes and a lot of individual stocks as well had been rallying to new heights. It was as if there was no chance of a second spike in coronavirus cases, a vaccine was imminent, and the worst was behind us. However, what we're seeing now is actually an increase in coronavirus cases, especially in the US, which is a big concern, obviously, if you're invested in the US stock market. And obviously, we still have no vaccine. And even if we do get a breakthrough in the vaccine in the next coming months, it's probably not going to be until 2021 that we see it publicly available to everyone. We're also experiencing protests and we have millions and millions of people unemployed. So what does this mean for you, right? What does this mean for your investment? Is now a good time to buy to get into the stock market? Should you sell or should you hold the stocks that you currently have if you're currently invested in the stock market? And the answer to that is going to be different, as I said earlier, for everyone and depends on a number of main factors, including your investment risk profile, how liquid your money is right now and how liquid you need it to be over a set period of time, whether that be the next couple of months or years. And also remember the emotional graph that we looked at the beginning of the video. Have a think about that. Have a think about where potentially on that graph stocks that you're looking into or you're thinking about investing or stocks that you already have in your portfolio investors are. Whether you think that it's near the top of that graph or near the bottom, because that's going to determine as well what the current state of the economy means for you and your investment portfolio. Now, I'm definitely not saying to base all of your investment decisions on this graph of emotions or to go against your emotions because you think that they might be wrong, but it helps you get in the right mindset to then make a decision which is going to be right for you. Now, let's look at some different investment strategies so that you can determine which one best suits you. Whether you're already invested in the stock market and have a position or whether you're thinking about starting to invest in the stock market, this is going to help you. And dollar cost averaging is the first strategy that I want to speak about. Dollar cost averaging is when you buy an equal amount of monetary value, in this case dollars, at regular intervals and keep investing into your portfolio that way. Now, this takes advantage of the dips in price that we experience in the stock market and means that you don't need to be too concerned with buying your whole position at once. This is great for passive investors and takes away some of the risk of going in too heavy at once, which if you do, for example, at the top of the emotional cycle and then it goes down, you're going to experience a huge loss. Remember, if you go in heavy or buy your entire position at one point, and this ends up being when the market is high, for example, you buy $100,000 of Microsoft and then it drops by 50%, let's just say, you've now got $50,000 of Microsoft. And to get back up to your original investment, which is $100,000, you need to gain more than a 50% increase, because a 50% increase is only going to be $25,000, which on top of your 50 is $75,000. So you're still down $25,000. So just think about that. Dollar cost averaging is a really good strategy, as I said, especially for passive investors. So if you are a passive investor who potentially sets aside a percentage of your income every month to invest in the stock market, like I do, you should think about continuing to invest that money even now. Now, I personally am going to keep investing every month, no matter what the stock market's doing, no matter what the trends are saying, I'm going to keep buying every month. Another way that you might hear people talking about this strategy is time in the market versus timing the market. And basically what they're saying here is that time in the market is better than trying to time the market, because no one can time the stock market, not even Warren Buffett. So guys, don't even try it. Time in the market is the best way. So you've got passive investing, which is one strategy, and another is day trading. Day trading is obviously when people trade daily to try and make gains on individual stocks. Now, this isn't something that I've done a lot of prior to the last 6 months, but because of the uncertainty that we've seen this year, I have started day trading. And guys, to demonstrate the volatility of day trading, I'm going to pull up my account here, and I actually made a video 2 or 3 weeks ago, which you can see here. And in this video, I spoke about how I made $2,000 in that month day trading on Revolut, which is the app that I use. The value of my portfolio then was $18,000 or just over, and now I've dropped to roughly or around $17,100. So as you can see, I've lost $900 in the last couple of weeks, and that's basically what happens when you try to day trade and time the market. I had made money in the past, but now I've lost $900 in the last couple of weeks. I'm still up $1,100 in the last 6 weeks, so it's not too bad. I'm not too concerned, and I'm going to hold my position there. But again, that shows the volatility that comes with day trading, and obviously it's very risky. So, is now the time to buy. It's now the time to inject more of your money into your portfolio and buy stocks. I'm not here to tell you exactly what you should do. However, if you're thinking about buying now, I'd seriously consider the threat of a second wave of coronavirus. As I said before, we've seen stocks rally immensely recently, and that just shows that the second threat of coronavirus isn't priced into these stocks. Because if it was, we'd be at a much lower price right now, which, if anything, the dip in prices that we saw at the back end of last week might suggest that we're starting to see the second threat of a coronavirus be priced into these stocks. If you have a long-term investment strategy and you're looking to invest for the next 5, 10, 20 years, I'd say that almost no time is a bad time to invest, but that's just my personal opinion. Obviously, I could be wrong. But if you buy great companies that have a track record like Apple, Johnson & Johnson, and Microsoft, these are likely to be smart buys now if you're looking at withdrawing in the next 10 or 20 years. So that covers should we buy right now. Now let's talk about should you sell. Should you sell your current position and your current investments? Well, that's something that only you can determine, but let's talk about what might influence that decision. If you're confident that you have invested in solid businesses that will recover from this pandemic if they haven't already, or if they do drop again, you believe are going to recover in the future, then you might want to consider holding and not selling your current investment. After all, guys, historic trends show that holding your investment and not trying to time the market does provide better returns into the future. But yeah, this is obviously only well and good if you can afford to leave your money in there. And that's why it's so important never to invest more than you can afford, because we never know what's going to happen in the stock market. We could see a downturn out of the blue at any time. So make sure, guys, that when you're investing, you're only putting in what you can afford to leave in there over a long period of time in case you need to. If you put in more than you can afford, it sort of stops being investing and it becomes gambling, basically, which is not what we're trying to do here. The truth is, though, no one knows. No one knows whether now is the time to buy, sell, or hold. No one knows, and it's not something that anyone can determine. Even the best people make huge mistakes when selling or buying stocks. An example here that anyone can appreciate and respect is Warren Buffett. Warren Buffett has been a net seller this year, and he sold his entire $4 billion stake in the airline industry, only for the likes of Delta, which he's believed to have owned about 10%, to rise over 60% between the 4th of May and the 6th of June, so about 1 month. Now, I'm not sure exactly when he sold his $4 billion stake in the airline industry, but it was prior to the 4th of May. Therefore, if we take Delta alone, he was believed to have owned about 58 million shares. Should you have had 58 million shares in Delta on the 4th of May, on the 6th of June, your shares would have gained around $900 million. So guys, to conclude, should you buy or should you sell? This really comes down to your personal circumstances, and it's going to be different for everyone. It depends on your current financial position and your goals over the next 5, 10, or 20 years. Having said that, I really hope this video helped you decide what's right for you. And if you've enjoyed it, smash the like button, guys. Give me a subscribe. I'd really appreciate it. And I'll see you next time.